Welcome. You know, if investing feels like trying to guess the weather or, I don't know, predict a hurricane, you are absolutely in the right place. Today, we're going to break down how you can build a simple, automated system for investing that takes all the fear and the guesswork out of the market. This is about building wealth with confidence. So let's get into it and start taming that chaos.
And this is the big question, isn't it? We see the headlines all the time. Stocks are soaring one day, crashing the next. It is so easy to feel like the whole thing is just a giant, chaotic casino. Are the people who win just getting lucky, or is there actually a method to all this madness? That feeling of uncertainty, that's exactly what keeps so many people from even starting.
You see, it all really boils down to two paths an investor can take. On the left, you've got the emotional investor. This is the person who gets swept up in the hype, chases trends, and panics when things go south. And on the other side, you have the systematic investor. This person has a plan and they stick to it. They operate with a clear, emotion-free strategy. Our goal today is to give you the roadmap for that second path. So let's start by looking at what is, without a doubt, the biggest hurdle for most investors. And here's a hint. It's not about picking the perfect stock. It's not about timing the market just right. No. The biggest hurdle is something much, much closer to home. It's our own human nature.
Think about it. We're human. We are wired with powerful emotions like fear and greed. And those emotions, they can lead to some classic blunders. We hear everyone talking about a stock that's just skyrocketing, right? So we jump in and buy at the very peak because we have a fear of missing out. Then, the market takes a totally normal dip and we panic and sell at the very bottom. That is the literal definition of buy high, sell low. And it's a painful cycle that a good system is designed to completely break.
Okay, so how do we defeat this enemy within? Well, we build a system. We build an automated set it and forget it kind of strategy that takes our emotional impulses right out of the equation. This system really has two core pillars that work together to enforce discipline. And the first pillar is something called dollar cost averaging, or DCA for short. I want you to think of this as the engine of consistency for your portfolio. Instead of stressing out and trying to guess the perfect time to buy, you just don't. You simply invest the same amount of money on the same day every single month like clockwork. The beauty of it is its simplicity. It just completely removes the guesswork.
And the process really is as simple as it looks. You pick an amount, say $200. You pick a date, let's go with the 15th. And that's it, your work is done. Now, when the market is down, your $200 actually buys more shares. And when the market is up, it buys a few less. Over time, this all averages out your purchase price. It turns market volatility from something to be scared of into a potential advantage.
Now for the second pillar, rebalancing. If dollar cost averaging is your engine, then rebalancing is your steering wheel. It's the process that keeps your portfolio on the right track, headed towards your goals. And it has a kind of secret superpower. It systematically forces you to buy low and sell high.
So how does that actually work? Well, imagine your stocks have just had a fantastic year. They've grown so much that they now make up a way bigger part of your portfolio than you originally planned. Rebalancing just means you'd sell some of those high-flying stocks, locking in your profits, and then you use that cash to buy more of the other assets in your portfolio, like bonds, that haven't done as well and are now relatively cheap. It's disciplined profit-taking and smart risk management, all rolled into one.
Okay, so we've got our system down. We have our engine and our steering wheel. Now, what do we actually put in the system? Well, we need a diversified set of tools or assets to build a portfolio that can weather any storm. Let's think of these as the ingredients for our investment recipe.
And a really great way to get these ingredients is through something called ETFs, or exchange-traded funds. The easiest way to think of an ETF is as a basket that holds hundreds, sometimes thousands, of different assets. So instead of buying just one stock, you can buy one ETF and instantly own a small piece of the entire market. As you can see here, our toolkit is going to focus on 5 core types, from US stocks to crypto, because that's how we're going to spread our risk effectively.
First up, we have our ordinary risk assets. These are the absolute foundation of your portfolio. They're designed for steady, long-term growth. This includes things like broad market indexes. Think the S&P 500, which is basically the 500 biggest companies in the US, or ETFs focused on things we all buy every day, like toothpaste and soda. These are the workhorses.
Next, we add a little spice with our high-risk assets. This is where you're really aiming for more aggressive, faster growth. We're talking about sectors with huge potential, like technology and semiconductors, or even cryptocurrencies like Bitcoin and Ethereum. Now, the key here, and this is really important, is that this is for capital you can afford to risk for that higher potential reward. And finally, we need our defensive assets. Their job isn't really to make you a ton of money. Their job is to protect the money you already have. You see, when the stock market gets choppy and volatile, assets like gold and short-term government bonds tend to hold their value, or sometimes even go up. They act as a crucial stabilizer for your whole portfolio.
All right, we've got the tools, we know what ingredients we can use. So how do we mix them all together? This part is crucial because it is not a one-size-fits-all solution. The right mix for you depends entirely on, well, you, your age, your goals, and your personal comfort level with risk.
A really classic, super straightforward guideline to get you started is the 100 minus age rule. It's simple. You just subtract your age from 100, and that number is roughly the percentage of your portfolio you might think about putting into higher risk assets. The logic is pretty simple too. The younger you are, the more time you have on your side to recover from any market downturns, so you can afford to take on a bit more risk.
And you can see exactly how this plays out across a lifetime right here. A 20-year-old, they might have an 80% allocation to growth assets. Why? Because they've got decades to let it ride and recover from any bumps in the road. On the flip side, someone who's nearing retirement is going to have a much more conservative mix, focused more on preserving the wealth they've worked so hard to build.
So what might this actually look like? Well, here's one possible blueprint for a balanced portfolio. You've got 60% as the core growth engine. Then, 15% is allocated for that higher growth potential. And a really solid 25% is in those defensive assets to manage the risk. Again, this is just one example, but it shows you how you can blend these different categories to create a portfolio that fits your unique risk profile.
We've covered the why, the how, and the what. But honestly, none of this matters if you don't take these ideas and make this system truly your own. This is all about taking these principles and applying them with your own independent thought.
And as you do that, please remember these crucial points. Investing is not a competition. It's not a race to see who gets the highest return in 1 year. Building a diversified portfolio is an exercise in managing risk. Its real goal is to deliver steady, long-term growth that you can actually count on. And that means ultimately you have to do your own homework because it's your money and it's your responsibility. This all brings us to the final and maybe most critical question. After all this information, you're probably wondering, okay, so what is it? What is the single, perfect, foolproof portfolio that works for everybody every single time?
The truth is, it doesn't exist. There is no single best portfolio. A perfect strategy on a spreadsheet is totally useless if you get scared and abandon it at the first sign of trouble. The best system, the one that will actually build you wealth over the long haul, is the one that fits your personality and your life so well that you can actually stick with it consistently through the good times and the bad. That discipline, that's the real secret to success.